Good afternoon, everybody. Welcome to the TraderMerlin Show. It is your Tuesday afternoon edition. As you notice, I've got my victorious 49ers shirt on today. I hope you had a victorious day in the markets as well. We try to present as much data as we can over the past few months and looking at just the stats and the figures that may paint as a rosy picture for the markets or maybe even a negative picture for the markets. And I was talking with John Rowland last week and thought about, well, what are you going to talk about? And certainly we can look at the normal things, which is going to be oil and gas. But I thought maybe we'll look at some other pieces of data. And I thought, with all of his years of experiences, what do you see coming down the road? And that led to the discussion for today's topic, which is signs that the recession is coming with John Rowland of barchart.com. John, how you doing, my friend?
How's it going, Merlin?
Fantastic. Good to have you. Good to have you with us again. It's been a little bit too long. I think a little over a month. I'm going to try to get you on monthly. But what's new in your world? What you been up to?
Yeah, same old, same old. Still working with barchart.com. We just started a new Friday show, Market on Close. We look at the market in the last half an hour before it closes. We look at the macro, the micro, look for trading opportunities, maybe present themselves in the coming week. So a lot of fun little cool segments, pick of the week, options you need to know, stuff like that.
Ooh, the pick of the week. All right. That was something I did years ago, and I actually stopped doing that. Well, I'll share with you offline why that was. But I may actually bring it back. I've got people asking me to do some kind of pick, so we may have to do that in the near future. So let's go into the broader picture here. No, we will dive into oil and gas, which, of course, you guys know John is a former floor trader for the oil and gas area. But I think that there's bigger macroeconomic pieces which may start to steer this market going forward. First thing we'll address is Santa Claus rally. Here we are, November, just right before Thanksgiving, and we're going to head in towards the tail end of the year, and everybody always says, Santa Claus rally, here it comes. Let me ask you first off, Santa going to come this year? We can all be overjoyed by Mr. Claus bringing presents to all of us traders?
Well, Santa comes every year. Of course he does, right? But the phenomenon of the Santa Claus rally is really more about portfolio managers who save amount of cash towards the end of the year, and then they use that cash, they put it in the market to inflate the assets that are in their portfolio so that their performance looks better, so they can get their Christmas bonus. Remember that Eddie Murphy, so they can get G.I. Joe with the Kung Fu grip for their kid, right? So, I think that is just a part of seasonality of the stock market and the way business is done. My question, though, for this year is that, this is the first year in a long time that we've actually had a down market going into December. So even no matter how much they try to inflate their portfolios, I don't know how good their bonuses are going to be. I did read something about that there's some kind of a street estimate, and they said that their bonuses were going to be about 45% lower than they were last year. Deservingly so, though, right?
Oh, heaven forbid. They're only going to get a $150,000 bonus. Jeez. Cry me a river.
Right.
Well, okay.
So, I mean, do you agree with me about the Santa Claus rally?
I think we'll get it. Look, all we have to do is just look at the statistics. The statistics show that more often than not, you're going to have a nice little pop. And of course, I guess it depends when the Santa Claus rally is taken from, right? I think the novice trader just thinks it's the whole month, like from November all the way through December, when statistically, they say the Santa Claus rally is the last 5 trading days of the year and the first 2 of the new year. That's what they call the Santa Claus rally day. Those are the measured metric. But, I think that there's going to be some optimism out there. You're right. This one does feel different. We feel like we're a little bit more beaten down. I'm on the fence because I see some good economic data and bad economic data at the same time. So trying not to go too big one direction or the other, but my gut would tell me we'll probably see a market pop through the end of the year.
Well, that's interesting that you said economic data. Let me just share something with you. You don't mind, do you?
Let me nerd out. I love data.
So, I think there's some things that we need to address in terms of, if we're talking about Santa Claus rally and the fact of, is it going to help the performance of stocks beyond what we just talked about? Is the consumer going to be buying Christmas presents? Now, I think the way with all these Black Friday things have been starting already before even Halloween, that they're kind of, cannibalizing the typical Christmas sales. But here's the personal savings rate. You can see it's It's actually right around 3%. It's actually the lowest it's been going back to before the great financial crisis. So, there's not a lot of excess cash flowing out there. And I think this one is really the telling sign. And that is consumer credit card debt. And now this is lagging for one month, but it is over $1 trillion now. And I just think people here, they're not saving money and they're spending a lot more money on their credit cards, which is kind of telling me that, they're struggling, right? They're struggling with paying their debt, paying, for regular, just normal goods.
Day-to-day livings, yeah.
Yeah, exactly. So,
it's funny, we were looking at, rental properties and things like that. Like, you could have gotten yourself a 2-bedroom, 1-bath apartment down here in Southern California for, I don't know, maybe $1,800 a year ago, and now a 2-bedroom, 1-bath apartment's like $3,000. It's like, hold on a second, how did we get there? And you're right, I think a lot of people might be pricing out. So with those two pieces of data, which I love, we're seeing saving rates just eviscerated, right? People aren't saving really anything anymore. Probably the lowest than you've seen since the 1960s. And then you also have consumer credit card debt rising, which means people are foregoing paying now. They'll pay at a later date, but you're also paying probably 12, 15, 20% interest on those cards. What does that paint for you as far as an economic picture? If we do feel like we're going to get a Santa Claus rally, that might be because of institutions kind of dressing the plate a little bit. But what does the time horizon look for you? When do you think the chickens come home to roost, so to speak, if we're not saving and we're spending like crazy?
Well, these are all leading indicators. So I think, you can think about 3 to 6 months forward. So, first quarter of next year, mid of next year. Again, I think it also depends on where the Fed's going to put their target rate. They keep raising or moving the goalposts or however you want to define it. Everybody thought they're going to pivot at like 4% or 3.5%, and now we're at 4.5%. Now we're talking about 5%. I don't think the Fed is going to pivot until they can get the Fed funds rate to parity with, let's say, the CPI, right? And if the CPI continues to, stay above 7% or 6.5%, then that is just going to add more pressure on them to raise rates. So, if we think about that and that kind of lag effect, as the Fed raises rates, and let's say they slow down 0.5%, right, from December, 0.5% in January. So what does that get us to? About 5.5% by March?
Yeah. And right. So the CPI number, we were at 8.2%. They expected it to drop to 7.9%. It came out at 7.7%. Now, of course, the Fed's going to go, well, we don't look at CPI. We look at the core PCE price index, but still showing high inflation. And then let me see real quick if I can bring this one up for everybody. I'll bring up, here's my CPI real quick. You see that CPI number, and then the Fed Funds Watch is the other one I want to look at. Notably, in the last 24 hours, we've seen a shift more towards a 75 basis point raise. Now, right now, it's about 75% chance that they're going to do 50 basis points at the December 14th meeting, and the other one is about 25% that we get 75 basis points. But remember, a month ago, it was more at 75 and then slowly drifting down because of that great CPI number. But John's right. It's going to have to come down and meet the inflation levels. And either inflation slows down and then they can start cutting these rates, or inflation is going to keep rising and they're going to have to keep raising rates aggressively to meet that inflation number. And to me, I would go on the latter of those two, which is, inflation is not going to really plummet. It'll slow down, and therefore rates will have to keep going up to meet that. At least what I think.
There's two points in what you just said there. First of all, I know that you like this chart because I've watched your show a lot. One of the great indicators of a recession is the yield curve. And what we'll see, I know you have it if you can pull it up, is that the yield curve, let's say the 1 year to the 10-year, is at the widest that it's been negative since, I don't know, the history of dawn of time. I don't know. Since what, 1970s?
I think so. I haven't, just so I'll bring it up for viewers can see it. This is the 10 and the 1 that John's referencing. I only have this going back into 2008, and it is the largest margin by a huge gap. And then the 10 and the 2, I have going all the way back into the 80s. So 1988 is where it goes back to. And it is also the biggest inversion that we have in that period of time.
So that usually leads a recession as well, about 6 months or so. So that's another component. Now, I have my own personal indicator. If you let me indulge me,
Yeah.
I call it the Chick-fil-A indicator.
Okay, I like this.
So we have this restaurant here on the East Coast. It's called Chick-fil-A. I don't know if you're familiar with it, but it's very, very popular.
Yeah, we have it all over the place here. I hate
Okay,
this place because the day of the week that I always want Chick-fil-A. Like seriously, it's like a drug addiction. Like I have to have it.
Sunday.
It's always on a freaking Sunday. It drives me crazy. Yes, I know Chick-fil-A well.
So you know how the lines go. In the Chick-fil-A in my town, they have 2-car lines, and it goes around the building like twice before. But what I've noticed in the last, let's say 3 to 6 months, is that double car line is getting smaller and smaller, and that is sometimes at lunchtime it's only a 1-car line. Meanwhile, across the street is a McDonald's, right? And that line 6 months or a year ago was very small, and now that one is double digits cars. So that's kind of telling me what we just talked about, is that the consumer is finding it difficult to pay for some luxury goods. And Chick-fil-A, I don't know if you've been to Chick-fil-A in recent, but I went with my wife, and we just stopped there for lunch one day, and we got 2 sandwiches, fries, and a Coke, and it was $21. I mean, come on, really?
Yeah.
I mean, that's my Chick-fil-A indicator that folks are not buying Chick-fil-A and they're buying McDonald's because it's a lot cheaper. Now, we can go into what's the difference between the quality of food, but I'm not going to step down that road.
You don't want to offend anybody there with the Chick-fil-A.
No.
All right, so from your perspective, you've got 2 interesting pieces of data. You had the consumer savings declining, you had consumer credit surging, a little bit about inflation, and then you, of course, have the Chick-fil-A indicator, the inverted yield curve. And you've been through this before. I mean, you have seen many recessions in your days. I guess what have you learned from a recessionary turn like this? And then what would be the best way in your mind to kind of prepare for it, or, just capitalize on a nice sell-off?
So you talk about market cycles, and there's a couple of things I think is very important for us. Now, we're going to get to oil and gas in a moment, but one of the best sector has been the oil sector. What I have noticed in the recent weeks is that even though oil stocks are doing well or rising, but they're not rising as fast as they were earlier in the year. But in a recessionary period, I want to own companies that are able to pass along the cost, the push through the cost, this inflationary cost. But as those pressures ease, in other words, the input cost of energy, the input cost of raw goods, as they ease, I want those companies that will be able to have pushed through those prices, and then as those input costs fall, they're going to be able to capture a greater premium. Then, in other words, those margins are going to get wider, and those usually are like your healthcare, your consumer staples, and if we see a fall in interest rates, we could also see the utility sector doing well. So again, let me share something here.
I'm saying it echoes back. It's weird. I'm not seeing anything on my end that says echo, so I'm trying to figure out what the problem is over here. But we'll make through it. So, all right.
It might be me. I might have got too close to a microphone.
No, you sound crystal clear to me. So I got bar chart. You got bar chart up here with a whole bunch of major market segments and indexes. So this is your typical
market sector performance. Yeah, exactly. So this is like over the year, and you can see the brown line here is the energy sector. So what we notice here is, it's still doing well. It's still outperforming the overall market, but you can see over the last, since about October, end of October, it's kind of just gone sideways, right? We had a little uptick today. It's gone sideways, but we're definitely starting to see some of these laggards throughout the year are starting to catch up with it. And these are healthcare, consumer discretionaries, materials, actually, industrials are doing well. So those kind of industries, I think, are the ones that we want to start to concentrate, especially in this market cycle. And if we go into a recessionary cycle, well, energy stocks and energy companies tend to do very badly during that segment. So I would be looking to rotate out of the energy sector, which I think we're starting to see, and start to rotate into these value sectors where that if we do see some deflationary impact from recession, those ones that are still going to continue to be able to maintain their sales, but also they're going to be able to increase their margin profits.
All right. I'm actually fixing something right now. I think I got it, guys. I think I fixed it. Thank you so much for the feedback. I actually had 2 audio inputs, so when I show this chart like this, when I showed the chart, I was getting audio feedback. So my bad. Anyway,
let's go one more step, right?
Yep.
So this is what I'm kind of saying is, right, here is the energy sector, and these are all different moving averages. Notice that 91% of all energy stocks are above their 200-day moving average, and 91 of them are above the 50-day moving average. Now, on the shorter term, the 5-day and the 20 days, they've been flipping back and forth. But notice how now we're starting to see consumer staples, right? 78, 80% of those are now above their 200-day moving. These are positive signs for these sectors, right? A lot of them are still at 50-50 or even below, right? Industrials, again, who's going to be able to push through prices, but then benefit when we get a little bit of a deflationary effect. You got to be careful with industrials, obviously, because they are very sensitive to recessionary periods too.
And looking at that, so hold on, scroll down there again. Those are some really interesting numbers. I'm looking at, and I like how it's, you've got some that are incredibly strong, like energy, obviously, and there typically is a rotation to these markets. I guess, how does sector rotation kind of play into your decision? Because you see down there at the bottom, one of the worst or not worst performers, but down 37%, and I'm assuming that means it's below its 200 period moving average, right? So 50 would be right on the moving average.
Right. So it means if 50 means half of them are above at the 200-day moving, right, and half of them are below the 200-day moving. So when you look at something, for instance, consumer services, that's telling you that almost a quarter of all consumer services are below their 200-day average. I mean, 3/4, only a quarter above.
Right. Well, utilities tend to do really well when markets start to roll over, right? And when markets start to decline, we're probably not cutting back on our electrical or water or anything like that. So utilities tend to do rather well, and it looks like they're actually doing very poorly right now, which I guess would bode well for the argument that we're still in a somewhat bullish phase, because we're not seeing those traditional recessionary items take the lead. Would that be
exactly? Yeah. But in case in point, though, if we look at their short-term moving averages, now look how many of them are above. Now the whole market kind of is rallying here. But when we think about utilities, we got to think about overall interest rates. So if overall interest rates are starting to fall, let's say the Fed starts affecting the market, then those ones will rise. If we look at, for instance, and I'm going to give you back control, but pull up something like the TLT, the bond market. So the question now becomes,
yep, I got TLT up here for you.
So the question becomes, a lot of times what we'll see is that the bond market will lead the stock market out of a recessionary periods, but we want to make sure that the bond market is going up for the right reasons, that it's going up because the expectation that interest rates are going to fall. I don't think that's what we're seeing. What I think we're seeing is that we're seeing the bond market rally because it's a kind of a flight to quality or a safety issue, and that's the wrong reasons for interest rates to come down. So I'm still think the verdict is out on utilities, but I will tell you that I've been watching a lot of dividend type stocks that pay higher dividends, and they had been under pressure for the last 6 months because interest rates have been rising, and there's that TINA effect, right? You can get a better short-term rate in the cash, treasuries than you could with the dividends. But I have noticed in the last few weeks or so that those type stocks that have been beaten down that pay good dividends are also ones that are starting to appreciate a little bit faster in the short run.
Going for income generation, huh?
Again, what's the reason why people are doing that, right? Because they are fearing that we are going to go into recession and that the greater stock market might actually move lower. Now, we could be talking about large caps, mega caps, those kind of things. And if you look at those stocks, right, I mean, certainly Amazon, Tesla, and Microsoft and Facebook, they don't give you a lot of encouragement, do they?
Nope. No, especially after the earnings calls. Although I it's funny, those are stocks I normally don't play, but the earnings was playing nice bounces on all of those. But I'm out of all of them now. except puts on Tesla. Let's shift to energy here. So natural gas is one that I was kind of dismayed, really, what happened between late July and the end of October, where it went from $10 down to $5. I mean, a 50% drop in the price of natural gas I thought was kind of crazy. And I was kind of wanting to get you on much sooner to talk about that. What on earth caused such a meteoric fall? I mean, it's one thing to rise quickly, but this was such a quick fall in natural gas. It just was bewildering. I almost tried to catch the falling knife here, and I go, no, not until I get John on.
Well, I think last time we came on, we talked about this.
Mm-hmm.
There was a seasonality effect that usually comes at the end of the summer, right? Domestic demand for natural gas falls because we're not using a lot of natural gas to create energy for air conditioning. We go into the fall, right? You open the windows, you don't have the air conditioner on, you don't have the heater on. So, residential demand falls. That was one thing. The other one was the Freeport LNG factory went down.
Right.
And now some people say, well, that should make gas prices go up. No, natural gas is a feedstock that creates LNG. So a major factory is not buying natural gas and turning it into LNG. That creates kind of a supply glut. So we had those two elements, the seasonality and the Freeport. And then on the other end, where's all this LNG was going to Europe. And Europe was like buying like a drunken sailor on leave, right? Just buying all over the place. And what happened was they had all these cargoes of LNG were like lined up in the Mediterranean and in the Atlantic over there because their infrastructure had reached a bottleneck. There was just not enough ports or ways to offload this LNG. So that kind of slumped the market as well. So Europe is well positioned in terms of supplies going into the winter now. I think they're at their normal 5-year average. Freeport is not back online, but now we're getting into that seasonality where we start seeing demand for natural gas start to rise here in the U.S. based on weather. Now, last week we had that little bit of a polar vortex that ran through. And that's why we got this little bit of a rally from like the low $5.50, $6. Now we're back above $7. So moving forward, I still think the tailwinds are good for natural gas. I think seasonality is going to play out from now until, let's say, President's Day weekend into February. And if we get another polar vortex or we get another series of, above normal cold weather, I still think that if we get about, let's say, about $7.50, $8 on the cash price, then we'll probably see $9, maybe attempt to test that $10. But let's go back to that recessionary picture. Natural gas is one of the most sensitive commodities when it comes to recession. And if we do go into recession, let's say in the first quarter, second quarter of next year, then I would not be surprised that natural gas prices fall dramatically, especially if we go into spring when we're not using heat and we're not having air conditioning, that we could fall back into, let's say, a low $5, maybe even the 450s with a recession as well. But there's still that base there, right? That base based on the LNG and the demand from Europe. And Europe will have to resupply their gas supplies going into next year. So I think there's a base price there for natural gas. So another, it's a put. But I still think natural gas prices, if you look pull up the chart of BOIL, the ETF, which is a leveraged ETF of the natural gas.
Yep.
And if you look at it, it has a nice double bottom here. It looks like it's about to break out around $50, right? I think that's about the value it is.
Yeah, $51.50. Huh. I love that it's actually priced at $51.50. That's just crazy. But I'm dumped. $51.50 right now.
So, I think if you wanted to play natural gas and you didn't want to play futures markets, this is a leverage ETF. It's very, very risky, I will say, but you will get a good picture of where natural gas is going to go by looking at this ETF.
Nice. Michael asks, it's a good question. He says, how can Europe be at their normal supply if one of the Nord Streams is down? So they may not be getting all the supply they need, but I think when you said their normal infrastructure capacity, right? You're talking about the pipelines are going to be jammed because of Nord Stream.
Yeah, they went out and bought as much as they could find, and that satisfied in the short run, right? So is it Michael? Michael makes a great point, is because that's the starting point. But if we go into and have a long extended winter, they're going to draw down those supplies, right? And they're not going to have enough time to replenish them. So that's going to shoot gas prices up even higher. So that's the scenario that I think is going to happen if we get above normal winter conditions.
All right. So bullish on natural gas, at least for the winter, and then we'll see what happens in spring as maybe things start to slow down a little bit. What about crude oil? I mean, it's been one that, for all intents and purposes, it just kind of feels like it's just bouncing between this, call it 80 and 95 range, which is still a great range for any traders out there, but no real clear trending direction at this moment in time. What do we look forward to with oil?
Well, let me do this. Let me share a screen.
Sure.
This is good. We're bantering. I love this.
Well, that's what I love banter. That's what it's all about. I mean, just talk markets, and then you get all the viewers involved too, which makes it fun.
So, can you see this is the crude oil Brent futures? So, what we learned from OPEC was that the last OPEC meeting, they basically said that they were going to try to hold oil prices at a certain level, and the whisper words that we heard out there was that Brent, which is more of a benchmark for world crude oil, was $85, and that's what they were going to try to hold. And you can kind of see we've been in this range between $85 and $100. Now, just yesterday, the Brent market popped below $85 because there was a rumor that they were going to increase production, but that is not the case, right? Saudis came out and denied it. So did Kuwait and a couple of other countries, and the market shot straight up. Now, if we look at this in terms of a technical analysis, a nice hammer here, we bounced off the low. So I wouldn't be surprised that crude oil prices range bound and maybe even get back above, let's say, $90 to $95. But we have to also think about that recessionary aspect. Now, let's go to our domestic contract, which is WTI, and which is kind of interesting is I know we've talked about this in the past, this backwardation and contango, right? The value of the spot month versus the forward contracts. And we've been in a backwardated market. In other words, the market has been in tight in supply, high in demand, and so that the current contracts have a premium over the contract months that go out in the futures. That backwardation has been narrowing at a pretty rapid rate. So I'm just going to kind of give you a little bit of a sense of what has been going on. So what I'm going to do is I'm going to put up just the March contract, which is 2 months out. This is the end of the cycle. And I'm going to change this just to a percentage scale so we can kind of see this. And then let me just change this back from a candlestick to a line, and make sure my compare is up there. Yep. And so let's see what is going on here. Why is it not showing me my March crude oil? In terms of percentage. It says right here, so I'm not wondering why it's not showing me. Maybe I got it. Wait a second. There we go. Let's try that. Anyhow, what we would see is that the January contract has been falling a lot faster than the March contract. That contango has been narrowing. So that's why it's maybe I got it figured out. Hang on. There we go. All right.
There it is.
So you can see here, of recent, the January contract has fallen about 18%, when the March contract is only about 16%. So that backwardation is narrow. Now, the last contract month, the December contract, actually closed at contango. That was yesterday. And this is the first time that one of our expiring contract months has done that in a while. And that usually is an indication that the market is either balanced or it's starting to move to oversupply. So as bullish as I am on natural gas, I'm actually starting to turn a little bit bearish on crude oil. Now, the problem, though, is I can't get too bearish because I got OPEC to deal with, right? Because if prices get too low, then OPEC will just cut production. So And then there's all these black swan events and stuff to go on. But I still believe that another reason why I want to be rotating out of the energy sector is because I do think that we're probably going to stabilize crude oil prices moving forward. And again, if we look at crude oil prices moving forward in our domestic market, you can see that, going out just about 6 months to a year, prices are down in the low $75. So if you look at Brent prices, it's about, low 80s. And the other thing is that the cost now, the freighter cost to move crude oil from the United States to places like China is now about $6.60 per barrel. So that discounts our crude oil prices even more, right? Because it's less competitive to buy crude oil here in the U.S. because it takes so much cost to move it all the way to, the extreme destinations like places like China.
It's interesting seeing all those, the forecast there on your CL, just getting lower and lower and lower and lower and lower. Scroll down the bottom there for me. It just goes all the way out to 2020. Wow.
Oh, the futures contracts go up for 10 years.
Huh.
So you can look out to 32 or something, right?
Yeah.
$57. Yeah, they're just not accurately traded, so I don't know how accurate those can be, right? But there's 12,000 open interest in the December 26 contract. Well, that's 4 years in the future.
Yeah. $66
not
a barrel.
Lot, but yeah.
Wow. Hey, we'll take 66. Currently sitting at 80. That'll be a long time sell-off there for that one.
Yeah.
All right. So we got gold out of the way. We got oil out of the way. We talked about some of your recessionary thoughts and where things may be headed. What's on your plate? I know you're supposed to be doing no webinars this week, right? You don't have any. I don't think you have any webinars this week.
No, I don't. I'm off this week.
All right.
So the only thing I really got going now is my Friday show. We're going to do one next week. And the following week, I'm doing a webinar. It's going to be more of an introductory base level and just basically how to navigate on the bar chart page. But some of the future segments I'm going to do, I think there's one in December. We're going to look at short condors. I think we're going to look at another technical index indicator, or the ADX, I think is one that we're thinking about doing. But, there's not a lot of time in December either, too, because we have the holidays.
Right.
And then after the first of the year, we usually do a special where we kind of pick a portfolio of stocks that we think are going to perform this year. And again, I'll share my screen for a second, if you don't mind.
Yep.
So this is the one from last year, which was 22 stocks for 22. And, I got to pat myself on the back here. I mean, considering the market has been down, 25, 30%, this portfolio, it's not great, but it's better than getting a sharp stick in the eye, right? It's up, just turned positive in the last few weeks or so. It's up 2.2%. But, look at some of the stocks that are in this portfolio. Let me break this down in terms of profit. These are the best ones: ConocoPhillips, Cheniere, right? LNG. Here's Archer Daniels, which is in crops and the grocery store of the world, so auto parts, right?
You've been so bullish on LNG as well.
Yeah, Mosaic, right? Fertilizers, right? Here's healthcare, right? Another healthcare, another consumer staple. This is energy and dividend play. This is a stock pays about an 8% dividend, right? And even Visa, financially, think about financial stocks, it's not doing well, but it's held its own over the years. So
it will, as soon as these people who are using more and more credit start missing payments, and all of a sudden they're paying 20% interest on their balance for the rest of their life. Yeah, the profits will start to move up.
I think so. Yeah, exactly. So, there are a lot of losers in here too, right? And but you can't pick them all.
No.
But in terms of this portfolio, I've been pretty pleased with it. Yeah. So we'll probably do another one of those in the beginning of the year. Probably not 22 stocks. I'll tell you what, that was very difficult for me. But
it's a lot of work.
Yeah, it is. I think a well-balanced, diverse portfolio can be achieved with somewhere between 9 or 10 stocks to maybe as much as 15 to 16 stocks.
Question from Patrick, going back to your spread trade there when you're looking at the contango piece. He says, isn't John getting ready for a spread trade on the March contract?
Yeah, well, March, April in natural gas, usually before the end of the time March, April comes to expiration, that March will move to somewhere around 5 to 6 cents premium to the April, but a lot of times it moves as much as 10 cents to the contango. So that's one that I'm definitely going to be watching. In terms of crude oil, again, if we come out of the winter season and we start seeing recession, I wouldn't be surprised if you see like the March crude oil contract start to fall into contango versus some of those floor contracts as well.
Nice. And then if you look over here to, I had it up there. You used to do a bunch of webinars. I don't see anything on the calendar for webinars. Is that because you're doing more on your Market on Close show on Fridays?
No, like I said, we're doing a webinar in next week is more of an introductory how to use the bar chart. Then I have a week off, some personal time off. I'm doing an exam. And then after I come back, we're going to probably, I think we're doing short condors. And then I think there's a technical analysis piece in there. I can't remember what it is. I think it's ADX, but don't hold me to it. And then we'll do like a wrap up end of the year show. We'll probably talk about the Santa Claus rally. We'll look at where we were a year ago and where we are now, and see if we can figure out things for next year. And then when I come back from the beginning of next year, then I'll probably do that portfolio show. So, there's some cool stuff we're going to do moving forward. And, I think we're going to concentrate more on like that technical aspect, indicators, momentum, oscillators, those kind of things, and just kind of really boil down looking for trading opportunities based on those, and also start showcasing a lot of the really cool features that are on barchart. One of the new pages that we have is our investing page. I don't know if you can see it.
Yep.
And if you open that up, there's a lot of cool investment ideas. One of the new ones that has really been very, very popular is watching to see what members of Congress are doing. And the insider trading page has been very popular as well, too. So,
politician insider trading, huh?
Yeah.
Wow.
So I think we'll look at a lot of that kind of stuff in the future. Right? We're going to use this page as a jumping off point to look for trading opportunities.
Nice. And the guy's always giving Nancy Pelosi a hard time. I'm seeing he's not even on the list. Come on, guys. You need to focus your attention on Louis Frankel, Joshua Gottheimer.
Jim Blumenthal has been very, very busy lately. He bought like $750,000 worth of JP Morgan stock about.
Oh, this Trey Hollingsworth?
Is it Trey Hollingsworth?
Yeah.
Maybe, I don't know. It was one. Yeah.
So how do you find out what they bought? Can you find out what they bought?
Yeah. If you click on it, it tells you the stocks that they bought.
Yeah, and this one is not telling me what he bought, but.
Yeah, you click on the.
But I'll look here at the Trey Holling. I'm scrolling down.
You scroll down and it tells you the. And I think it says he bought JP Morgan. And if you look at the date that he bought it, and then you look at the JP Morgan chart, you'd be like, "Whoa, God, this guy's a really good stock picker." So
convenient how he just nails the bottom.
It's amazing how these people. I mean, these people are really good traders.
Yeah, I'll find it another time. But that's another resource for you investing. I like the site because people have asked me all the time about candlestick patterns, which is one of my personal favorites. And if you guys want to kind of shortcut a filtering process, if you go here and you go to candlestick patterns, we talked about hammers, which is one of my favorites. Well, here's hammers, 119 of them, and there you go. Oh, yeah. Hammer pattern on a crypto mining company. Probably not going long. I'll probably stay away from those ones as well. But
yeah, I would probably stay away from. Well, we have a little time here. But do you feel that the contagion is over, or is this? No. I know you did a show yesterday. I didn't watch it, but is there more badness to come, so to speak?
Yeah. Yeah, you still have the fallout. You still don't know who's been in bed with FTX and Alameda Research, and all of a sudden you see Genesis got caught up in this, and then Genesis is tied to the DCG, and the DCG is tied to Grayscale. So all of a sudden Grayscale is now in issues, and they're trying to force Grayscale to prove their reserves, and Grayscale's going, no, we don't want to for security reasons. If it leaks at all that Grayscale doesn't have the Bitcoin that they say they do, then this is really a monster big piece that could be another black swan. So I think you're going to start seeing some of the major exchanges like Coinbase and Kraken and Binance. Everyone's going to be questioning their transparency, questioning funds. Where is it at? Are you actually staking these instruments? And I think that creates a lot more uncertainty, which is why you're seeing the exodus right now, which is part of my class tonight is I'll be moving cryptos off of exchanges, moving them onto my cold storage, and then doing self-staking and nominating validators myself. So I know I'm never going to be dealing with a centralized exchange who could steal my money.
Right. So don't you think that could be a catalyst in terms of, let's say, risk on, risk off, catalyst of, people who have excess money to invest in the market, so to speak? That could be one of the catalysts that could put us more in the recessionary, especially in terms of the stock market.
I think part of it is you'll see people pulling money out of the crypto world to help with their other day-to-day expenses or credit, or just to kind of, if they've gone into that risk-on asset class, which I would say is crypto, which would be the super risk-on asset class. I think part of it is people are just scared and pulling money out. So where are they going to park that? Well, I could definitely see it coming into the equity markets if it's the right investments. So I don't think it'll rise across the board.
Or you got a 1-year note that's giving you 5.5% return.
Yeah. Or I can buy an I-bond, which it's now 6.9, but yeah. Just crazy rates you can get safer by buying government bonds. Sure, government's got to be loving that, but I still think that there's pain ahead for crypto, and that contagion, in my opinion, is not done.
Right.
All right, John. Well, thanks for coming on today. I appreciate it. I hope that you and your family do something fun and exciting for Thanksgiving. I'm sure you're going to gorge yourself on turkey and prime rib, unless you switch to being vegetarian over the last couple months. I don't know.
Yeah, beyond turkey.
Beyond turkey. I don't know. Did you see the footage of the Beyond Meat factory?
No.
Oh man, if you are a Beyond Meat customer, I would not recommend searching for.
Watch it, right?
It's horrible. It looks so bad. Like there's just mold on all these things, and it's a garbage dump inside of that. And I don't know how true this is. Maybe it's slander from Tyson Foods or something. But man, I'll stick with the real deal. It's gonna be some nice turkey. So yeah, we'll have a little Thanksgiving here as well. So anyway, I wish you a happy Thanksgiving, and thanks to you and Barchart for all that you do. Maybe we'll get you back on in December for a little Santa Claus chatter. If not, have a wonderful holiday, my friend. We'll talk to you soon.
I will say, let me just turn my camera on here. Buddy, best to you. Happy Thanksgiving. If I don't see you before the end of the year, Happy New Year, and stay safe out there. I worry about you in that crypto world. I know you're a smart trader and you have a trade plan, but please be safe.
Oh, yeah. I'm not.
December is always a crazy month. You know that.
Yeah. And crypto is a portion of what I do. It's not all I do. Come on, I know. I think I do more consistently through options and equities and futures than I would on crypto. But the future 10 years down the road will be much more digital asset based, but we'll see. Time will tell.
Well, next time you need an expert opinion about natural gas or something, give me a call. You know where I can.
All right. Well, I'll give you a call tomorrow, and we'll be good to go. No, I'm just kidding. Anyway, have a great Thanksgiving. I hope that all is well with you, and we'll talk to you soon.
All right, buddy.
All right, take it. All right, everybody. This is John Rowland of barchart.com giving us some insights into quite a few things. Natural gas, crude oil, and recession. Who knows if this really is a recession going forward. I thought it was interesting because per our conversation, John was like, yeah, I see signs of a recession coming. And it doesn't mean that it's coming, and it also doesn't mean that it's not coming. It's just, hey, here are things to look at which may steer the course of the markets going forward. As I mentioned, I was kind of skeptical on where our markets are. I have some short positions, I have some long positions. I closed out my Qs today, but I'm still holding my S&P just to lighten the load a little bit here. I kind of felt like we'll start to see some markets rallying. We didn't have a huge day, but I will share with you what happened out there today. This is from bottom to top. We'll start at the low end. Here is your GC. So gold, if you watch the Monday Morning Must-Knows, I was looking for a pullback down to around that 1710 mark. There's a little demand zone right there, which I thought we might see more downside movement towards it, but Today, actually, a 0.02% gain for gold, so not much of a change, although it had a long topping tail on it, so that still bodes well for anybody who might be bearish. Russell 2000 on the day was up 1.12%, and you notice most of these are just kind of stuck in a small little range. The S&P is a little bit different, but the Russell was up 1.12%. Nothing really technically exciting. You had a 1.14% gain for crude oil today, which had some great follow through from a wonderful looking hammer formation. I mean, this is the mother of hammers. This is Paul Bunyan over here type of hammer. Well, he was an axe, wasn't he, not a hammer. But you could see that really long bottoming tail there. We opened below it, broke above the high, and had a really great runner for a while, and then came back and still positive on the day, about 1.14%. Here's your Dow, 1.16%, which is probably the best looking because it's just strong like bull right into overhead supply. S&P 500 was 1.32%, which looked better than the Russell because it broke above the last 3 days trading range, or 3 trading sessions. So that's positive, although it's got to get above these highs that go back to November 15th. And well, given the momentum, that could easily happen. And there you go, Thor's hammer. That's right, Lori. Paul Bunyan didn't have a hammer. And then NASDAQ, 1.44% today. It started off a little bit weaker than the S&P, but then just overtook it and was looking really strong. So I'm kind of glad I got out of that one, although I have some losses on the S&P right now. But we'll see what happens by the remainder of this week and maybe next week. And lastly, you got Bitcoin, 2.33% gain, back above 16,000. But again, I'm not overly optimistic. I just think there's too many possible negative pieces for this crypto market. So downside to me seems the most logical, plausible direction for markets to go. Now, as far as economic data and announcements, I thought I would share this with you. You have for today, just great earnings. I mean, look at like Canadian Solar. They beat by 90. They almost doubled their earnings. You had Abercrombie & Fitch doubled their earnings. You had Dollar Tree. Abercrombie & Fitch, Best Buy also beat earnings. So everything's looking pretty good for most of these. Yes, I am. I'm not short the S&P. I'm long puts. So that's probably going to be a loser. I have to cut off here fairly soon if it keeps rallying up. What was noteworthy here is you guys always hear me give grief to people who trade earnings. Look at Burlington down there at the bottom, BURL. This was brutal. So you might have been long Burlington thinking, oh, yeah, great. Retailers are doing so well. You might have been short Burlington just based off its Burlington coat factories. They missed by a huge margin. They missed by 17%, yet they had almost a 20% pop in price today. That was kind of funny. You just never know which way earnings are going to go, which is why I generally shy away from those for most of my markets and trades. Yeah, just options there. Not too many. I mean, I have 40 right now, so obviously that's a little bit of a pain today, but we'll see what ultimately happens. I got another couple $1,000s worth of profit on that one. Another few thousand worth of loss potential is what I've given myself, but I'll leave it there. All right, and lastly, I had one more chart to show you, which I did not put in my slides apparently, and that was your economic calendar for tomorrow. And then tomorrow I have no show or no guest tomorrow, so I'm going to really kind of catch up on the questions that came through. Hey, good to see you, Don. Don over there doing all kinds of shows, man. What's going on? Where's my invite? I got Don on the show a dozen times or so, and he won't even let me on his show. I see how it is, buddy. I see how it is. Anyway, here is your economic calendar for tomorrow. Most of the bad stuff's happening really with manufacturing and services PMI numbers. You have the Euro, you have the German markets, EU combined, you have French, you have the UK and the US. So we'll get a good sense as to flash services, manufacturing data all around the world. There we go. And then for the US, durable goods orders. You've seen the retail sales numbers do very well. The previous number was great. A lot of the retailers are doing great as well. We'll also see tomorrow durable goods orders, how that will pan out. Not quite sure which way it's going to go. They're expecting it to stay right where it's at 0.4%. Manufacturing numbers we talked about. And then lastly down there you have new home sales. That one is the only negative piece here, which looks like it's going from 603 to 570 is the expectation. My guess is probably even worse, given how quickly that 30-year fixed rate mortgage has skyrocketed. Oh, you a million times? Hey, I'm ready anytime. Come on, anytime. I'm always ready to talk something about markets. It's enough that I got to talk on this show. I'm ready to go. Merlin, do you take a break from trading during the holidays? Yes, I do. I will have positions open for sure, but I'm not going to be, scouring the markets, analyzing them every day. I don't do anything on Thursday. I will do nothing on Friday. So really, you should all make it a 4-day weekend. I know it's a half day on Friday. Screw it. Don't even look at the markets. Just if you have no positions open, then just stay out of it altogether. You got it, buddy. I'll shoot you a text. We'll get something set up on the calendar. But definitely take the day off. It's not worth it for a half day. Yeah, you might have made a couple of bucks, but for a half day, you'd rather just go on vacation, enjoy time with family and friends. Markets will always be there. Family and friends won't. As I was reminded, as a friend was killed in a car accident on Saturday, very young, healthy, great, energetic young lady, and just ticket got punched Saturday night in a car accident. You just never know. So do as much as you can with your family and friends, and enjoy the time that we have on this wonderful spinning ball called Earth. All right, that's going to do it for me. Tomorrow, I'm just going to catch up on a bunch of listener questions. Same channel, same time. If you have anything you want me to discuss, you can email me, TraderMerlin@gmail.com, or put them down below any of the YouTube videos I've got out there. I'm more than happy to incorporate those into the slide decks and get that all answered today. Down some Fridays on the markets because markets can't be closed 3 days in a row. Yep, that's true. It's funny because they have been, but that was, was it 9/11? There was one day where they actually were closed 4 days in a row, which they're technically not supposed to do. They have to open. So, yeah, no, I mean, it's life, guys. That's the way it is. Anyway, thank you guys so much. I will see you tomorrow for our last show for the week, because I won't be doing a show Thursday or Friday. But join us tomorrow, and I'll probably have a nice glass of whiskey and join you guys for a drink on the show. Take care, everyone. I'll see you tomorrow.